All right, so stocks finished the week on a sour note, but not nearly as bad as it could have been. Again, there's kind of draw some parallels to Wednesday's close. And Wednesday's close, we were kind of sitting on the precipice and fell over. Today's, we were kind of sitting on a precipice, and we actually bounced up a little at the close. So we're going to talk about, why that was bullish and how it could have been worse and what it means and still what our sentiment looks like heading into next week, considering the type of week we've had. So we're going to kind of look at it on a daily basis and a weekly level to see what the technical patterns look like, so we can know what to expect going into next week. We'll also talk about, again, the major moves that we're seeing kind of on a broad level across different asset classes and across different types of equities. And then our trade idea is a stock that is kind of emblematic of a stock that's just starting to get bearish. Right? Everything else has been so bearish. Here's one that's just starting to. So how do we trade that? We'll take a look at that. So let's go ahead and get started. Today is Friday, December the 3rd, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we have a down day today, but it wasn't as bad. The close ended up being really good. Again, it wasn't the best. Like, we didn't close up above, up at the highs of the day. But we also didn't close at the lows. And that, we didn't close below the last couple days lows, which would have been, that would have been like what happened on Wednesday. And that was the this one right here. That would have been the big concern when we, at the end of the day on Wednesday, we really we were holding these lows fine right there from the previous day, and everything was fine until the last however long, and we just threw up over ourselves there at the very end, and that was a concern today as we were kind of holding these lows, and it was like, okay, are we going to really fall out of bed here at the close and finish down here at 44.50 potentially, and then really kind of come back Monday with a down day. But the fact that we didn't is a good sign from a short-term perspective. I don't think it necessarily changes the trend back to a bullish trend, but at least stops the bleeding, and from a short-term perspective, leads to what may be a little bit of a short-term bounce, at least on Monday. That's kind of what I'm looking at. The posture is still bearish, like we are below 40. So we are definitely in, according to this chart, we are in intermediate pullback mode. We're only down 2% though, and we only got 2.6%. So we're not really that far below the 30-day moving average. Obviously, we're a lot further below the 30-day moving average on the Russell 2000. We got an oversold cluster a couple days ago, and we're 7% below. So the intermediate line's in the lower reversal zone. The near-term line's been in bearish territory for a while, so it's a lot more bearish on the Russell than it is on SPX. But again, not as bearish as it could be, and dark pink shading in a red line, intermediate line below 40. Those are all bearish signs. Let's take a look at the weekly chart for this, and you can see that the near-term line is in the lower reversal zone. So that's when we're in intermediate pullback mode is when the intermediate line gets, the near-term line on the weekly chart gets into the lower reversal zone, or at least in the bearish territory by a good amount, and that's what we are now. So we are this would tell us we are in intermediate pullback mode. Of course, when you're in market sentiment mode is when the intermediate line drops, gets down into out of this upper reversal zone and works its way down, and you can see the last few times that happened, and we're not there yet though. Again, it's relatively more bear. It's one of our more bearish near-term drops that we've had, all associated with intermediate declines, and this is a quick intermediate decline after not having one for so long here. This big long stretch, which is very, very high. Now we have one really, really quickly. So, and again, if now look at the Russell 2000s weekly, and obviously the intermediate line is easily below the lower reversal zone. In fact, we have a red line, 30-week moving we're below the 30-week moving average, and it's falling. So, we're obviously nowhere near that on SPX. We have the green line, and then on NDX we even, same thing. So very different scenario here with the light pink shading on this, and because we're below 80, and the red line. So I mean, that's, you can see, like, it's not too common for us to get this kind of pattern here, light pink shading a red line and getting below the moving average too. We were earlier this year, but again, this is a bit more bearish than what we've seen the last this period. You notice the near term line never got in the reversal zone, and now we are, and the intermediate line's almost back below 60 again. So very significantly bearish on the Russell 2000 on the market forecast chart. Let's take a look at the weekly chart from this perspective. And you can see, we got the red line. We're below the 10-week exponential moving average. The PPO is falling. It's back below 6% now, just barely. We have the negative differential on the PPO. It's even worse on the Russell. The Russell is actually flirting with the 40-week exponential moving average. Much more bearish negative differential on the PPO, like a bigger candle than we've seen this whole time. So very bearish from that perspective. And then and the PPO is only at 3% now. So now let's look at the three green arrows, and you can see all of them light pink shading, all multiple days. Remember, it's okay to get light pink shading if you bounce back up after just one day, but now they're all multiple days, so this is all bearish. Now the MACD is rising, so we're in kind of bearish, potentially in bearish convergence mode. If you look at the two-line versions here, we're actually still in bearish divergence. We're still below the 17-day moving average. MACD is still below its moving average. So that's still bearish divergence mode, where we're diverging to the downside here. If you look at the Russell 2000, it's even more so the case, right? But the MACD is, at least the histogram is here. Remember, the histogram peaks before, or bottoms before the actual MACD does. So, but it's pretty quick on the downside. So if if the histogram is bottom, that means the MACD is probably bottoming too, which means we may be leaning more towards a bearish convergence where the MACD crosses above. See, when it crosses above the moving average, but we're still below the 17-day, that's a convergence. And then you get a new divergence to the downside. So we'll see if that ends up being the case here, if we start slowing down this descent a little bit. The other thing to really keep an eye on here, and we'll look at it again on a different chart, is we are sitting right there at the value area, the bottom of the value area, which means if we get below that, then it's really look out below from this point, because 70% of all of this year's volume is in this narrow band of about 212 to 229. So about 18 points, less than 10% band. That's 70% of this year's volume. That's how tight the range is. And we thought, oh, we're breaking out to the upside. But again, how dangerous fake outs are, because we thought we were breaking out of this very sideways range with a breakout bullish move, and then we come right back into it, and now we're testing the downside of it, which again, now you've got all these buyers in here that are all like, biting their fingernails, wondering, again, the weakest of weak hands. And so it's very important to kind of watch the bottom of this over this next week to see if we get to new lows. If we get to a lower low next week compared to this week's low, then that's not going to be a good sign, especially if we also drop below the 38% or 23% Fibonacci retracement level of the post-COVID move, right here, of this entire move. So again, there's not very much volume until you get down to the 62% retracement level, right about to 158 or so. Let's take a look at some of these other oscillators. You can see the RSI for SPX is in the lower half of the chart now. It's kind of been intermediate pullback mode. We are definitely below negative 100, and still, remember, it's okay to go below 0 when you're in bullish trending, but you have to come right back up. And you can see how we stay down there now. We're staying, or then in September on that intermediate pullback, we're staying down there again now. That's also the case here for the Russell 2000. You can see we're below 40 on the RSI. And we've been below 40 this whole time, so it's again one thing to dip down there, but it's another thing to stay down there, and we're staying below 0 as well on the CCI. The DMI is relatively bearish for both. It's not as bad on SPY because of this close, but the positive is really, really low. The negative indicator hasn't really made its run yet. SIWM, negative indicator did get up above 35 and has been pulling back, is now dipped back below 30. But look at that positive. I mean, not too common for the positive to get that low. The last time we got that low was the COVID drop, and before that it was the fourth quarter of 2018, and we see how we got down there, and that kind of started the bearishness, and then a little bit there in the beginning of 2018, and then you'd have to go back even further to the 15-16 area, right? Here in 2014, the Ebola, and then there's your 15 and 16, and that started more of a market sentiment decline. So a little concerning that they may be starting that may be a signaling that we're going to be in more than just an intermediate decline and more of a market sentiment decline, where we that lasts 3 to 6 months instead of 1 to 3 months, which is what your typical intermediate decline lasts. If you look at the Ichimoku trend cloud, SPY is below the blue line. That's what it does. But at least they're both, at least the green line is still above the blue. At least they're both still above the cloud. The red line was below price earlier today, but it made a run off of the lows. We don't have a bullish trend, but at least we don't have a bearish trend going anymore either. But again, IWM is a little bit different story. We are below the cloud now. We got below it. We tried to bounce up. We stayed below it. You can see the blue and green lines are almost the red line's below the cloud now. It's gotten below the price in the cloud, but the blue line and green line haven't quite yet. We have a stronger bearish trend than we've ever had. Right? We got close over here with -3 and 78, so we got really close. But this one we are now below. We have -4.97, so almost at the -5, and 83 on the trend noise balance indicator. So this is signaling that we may again we are in more of a decline on the Russell 2000. So here's what I wanted to talk about. So SPY's got a lot of volume. Look at all that support. So I'm not as concerned about the S&P. We're in the lower quartile. IWM is what I'm more concerned about, because we are below the point of control. We're almost below the value area. We've got a very high bandwidth. We're in the lower quartile. We've been pushing below the Keltner channels on IWM. We've been pushing below the Keltner channels. We closed below the Keltner channel again, so we're trending. That's not the case yet on SPY. We are above the right now. The band is sitting right on the Keltner channel. We haven't really we only had one day on Wednesday where we actually closed below both. So we're not quite there yet. We are in the lower quartile, but we didn't fall out of bed at the end of the day today, so we stayed above the Keltner channel. So not as bad yet there. Let's take a look at today's intraday moves. So we'll look at here. And you can see there's a nice little close at the end. Not so bad. IWM, same thing. We've been filling. We don't have any gaps other than this runaway gap that we had, the bearish runaway gap there. We don't have any gaps here to fill in. Lower highs. We did close below last week's low. We did close around. I think we got up above. Yeah, we barely got above yesterday's low on the Russell 2000. If you look at SPY, we avoided closing below yesterday's low. We are below last week's low, so that's bearish there. And then the Qs, we fell out a bit on Wednesday. We got below last week's low. We tried to make a run back up yesterday, and it was a great close above last week's low. But then today, we did close below last week's low. We did close below yesterday's low, even with the rally. So so the Qs are finally kind of joining the party, which, again, that's now the concern. We were okay early, but now that the Qs are joining the party, now it's like we may be in more of a decline than we ever have been, because that's been the safe haven trade, and now it's not acting like a safe haven trade, just getting its own bearish candles here. If you take a look at today's volume and trading range, whoops, not that chart. This chart, you can see the trading range is well above the average, 11.38 points. You don't have to worry about a gap. Again, 137 million. So really, these averages are ramping up big time. So look, we're already above. The ATR is already above where it was at during the actual intermediate decline. So remember, and usually these intermediate declines don't end until 2%. And if we are indeed in a market sentiment decline, you can see the last few times we got a market sentiment decline, we got above 2% over there, and we were flirting with the top of 2% there. So So, again, expect that we'll get to probably 2%. The ATR will probably get up to 8 or 9 points, and volume will probably get up to these higher levels like it did last time. So, we had 137 million, so that's about there. So expect we'll have more days like this. We'll have more days with down days and some more green up days after these down days, until we get until the historical volatility crosses over the implied volatility. That's usually your signal that the intermediate or market sentiment move that you're on right now is over with. If I were to go back to like the end of, here's the COVID low, you can see all these other times where historical volatility crosses up above, and that's generally the time that we bottom out, right? And so you can see we are not there right now, not even close to being there right now. And then finally, if you look at the volatility index, you can see that we didn't close. We were really ramping up at the end of the day, but we stopped there, and it came all the way back down to 30. We came all the way back below 100%. So again, not nearly as bad as it could have been, but really need to watch really closely on Monday, because if we get to 105 or higher, then that's kind of your sign that it's going to be a month or two or three before we not until we get an up day, right? We'll get plenty of up days during a market sentiment decline. Just to kind of remind you here, this was right here was a market sentiment decline that started here in October. There's where it started, and then there's where it ended here the day after Christmas. So look, there's the period of the market sentiment decline there. Look at all the up days, right? So it's not going to be 1 to 3 months of no up days, right? There'll be plenty of up days, but it'll be 1 to 3 months of a lot of down days in there, more down days than up days, and that's how we trend lower. So that's when we get these up days, then you can see you don't get a lot of them. You get some. There's the COVID. You got some, but you notice you didn't get a whole lot back to back to back. You got a 3-day win streak right there, but not a whole lot of back to back to back moves. You go out to over here. You did have a 6 out of 7 days there, but then you can see everything else wasn't very much back to back. So that's here we are, and we'll get an update or two next week, and if this is the same type of pullback, then those are going to be the days that we can look for bear call spreads to sell into, those up days. So next week, there might, like I said, there may be an update or two, but I expect that we'll get more down days next week, more than more down days than up days. Here's the weekly chart. So here's all the weekly candles, and you can see again, there's your market sentiment decline. So you do have a few weeks within a market sentiment decline that are positive, but they're going to be mostly bearish. There's your COVID drop. Basically, it was about a 5-week, 6-week drop with one little positive week in between. So there's your pretty much your market sentiment decline, or intermediate decline, and a few small, finish with that bearish move. This was our more recent intermediate decline there. This is what we're on right now. So I expect we'll get more of these red candles, and bigger. Like, we still haven't really had a big bear candle in SPY. All these others, look, we had 3-week drops, 3% drops. We haven't had that yet. This is still more typical of an intermediate decline, but not on IWM, right? We've had now 3 weeks of real significant 3% drops. So that's, and you can see how big the VIX is, the implied volatility has gotten for the Russell. So I expect we'll probably get another one of these, and another one of those that will actually hit the 3% mark on the NASDAQ, or especially on SPY, because we haven't had one yet, right? And that will really signal that, one of these kind of moves, that we are in bigger decline mode. I expect that may be next week may be the week that we actually get one of those. And if it is, then we know what we got. If it's not, if we get a positive week next week, then this may be just a short-term intermediate decline, and here we're done. Maybe just a 1-monther, and we're back to the seasonality and the Santa Claus rally and January effect and everything else that we can expect out of that. So I lean towards the former. That's kind of what I'm expecting, but obviously there are some odds that the latter can occur. So you need to be aware of that possibility, though I expect I'm more likely lean to the former side, where I think next week may be the week on the S&P we finally do get one of these big 3% drops. What do you think? Do you agree with that assessment? Do you disagree with all these charts we've been looking at here? Are there any other charts that I didn't bring up that you've been looking at that would suggest why you're either a lot more bearish than I am or a lot more bullish than I am? Share those in the comment section down below. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, you liked the video today. And number two, you want us to do another video again tomorrow. Or Monday. Quick way to give us feedback if you like our stuff. Of course, if you don't like it, you don't have to click on anything. But if you do like it and you want to let us know, those thumbs up go a long way for us. It helps us get our content out to more and more people. So we appreciate those of you who do click on that. Also, comment down there. What did you get out of the video today? What stood out to you? What questions or comments do you have? Post those in the comment section below. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these things over here on the right. Click on this icon, Market Outlook Live, that takes you to this page. Every day that I do the Market Outlook at 3:30 Eastern Time, we also do this Market Outlook live video. I review old Market Outlook trades to see whether we should stay in them or not, or get out of them. We talk about why and how. We also put on today's trade idea already before the market closes. In the case of today, that went out to our premium subscribers. We didn't do a video today because I was out of the office this afternoon. But all the archives for all the other days are here as well. Listed on this same page. Again, you just get to it here by clicking on that, or you can come up here to the top and click on Market Outlook Live Trade Review. Here's our upcoming classes. If you click on View More down below, you can get to our calendar of all our upcoming classes and all our recordings going back all 3 years. You can see all the calendar going back 3 years there. You can also get to that calendar by clicking on Trading Rooms. Come down here, hit this heart icon, opens up this tab, hit that like button. Also, while you're here, hit that thumbs up icon. It opens up another new tab. Hit that like button right there. Again, the more you do that, it helps get our content out to all of our followers. So that's why we always ask for it. It also benefits YouTube because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us right here while you're watching. All right, if you look at some of these charts, again, this is kind of the risk on, risk off charts, and you look at the 10-year yield dropping today, dropping down pretty significantly below the last couple of weeks' lows. So that means TLT is rising up pretty good. You can see global stocks are in dark pink shading in a red line now. So that's emerging markets down here, developed markets even worse. U.S. stocks now dropping below. You can see silver is way below its moving average, copper as well. Bitcoin shows a light pink shading there because we're at 22 on the intermediate line and rising. But here in the overnight session, it's dropping hard, like really, really hard. So it's going to be interesting to see. It's only a weekend, so it's probably very thinly traded. But it'll be interesting to see what Bitcoin does. Again, Bitcoin's in my opinion, a reflection of really speculative risk appetite. I don't believe it's a hedge. I believe it's speculation. It's a proxy for speculation demand. And boy, is it getting hammered tonight. So we'll see how that blends into other risk on trades once we get to the open market Sunday evening, and then again very thinly traded Sunday evening. So really Monday morning. When the volume starts to kick in, first from Europe and then of course here in the U.S. Open. Let's take a look here at the comparison chart of these different asset classes, and we'll just look at including Friday. So this would be during this decline that we've been on. So starting on the Friday of post Thanksgiving and through now, you can see the big rally we've had in gold and global bonds. The dollar and currencies, so UUP, I say currencies, as you see why in a second here, but gold and currencies are doing really well. High yield bonds are outperforming. There's all your equity asset classes, international stocks outpacing U.S. stocks, and commodities and small caps really getting hit pretty hard. I say currencies before because the implication is when we are down, the dollar does well. But actually, if you look at how the dollar has performed here since this selling started on the 26th, that's not necessarily been the case. In fact, the euro's been up against the dollar, and so has the franc and the yen. Those are your safety trades, and usually the dollar's up there with them, but not right now because the dollar is less of a safety trade than it has been in the past, because it's been the euro now. It's been more safety, and you can see the Mexican pesos up there, and all your commodity currencies all really getting beat up really hard, and the pound now is down for the week against the US dollar. Now let's take a look here at the major all the major global economies that are out there, and we'll look at the 12 grid for, again, China and Japan and Germany. And there's a pretty dominant theme here, whether even in the light green shading we have red lines. Brazil's obviously been in a convergence mode here for a while, but everything else is in bearish divergence mode. Everything is dark pink shading and red lines and well below moving averages, and so we are definitely shifting into a risk-off environment globally across, whether it's developed markets, emerging markets, doesn't matter. They're all globally really starting to work their way. If we take a look at the sector grid here in the S&P 500, and now you can see all the dark pink shading and red lines that we're getting there. A few yellow lines in materials and real estate, and still some light green shading above. We're just at 21 on energy, and you can see XLK and XLY are just kind of getting started. XLC has already been down. Utilities is holding up pretty well as you'd expect. Staples holding up pretty well as you'd expect. In real estate, you can see, look at those numbers. They're just really small negative numbers. You're down 13% XLC, and you're still got some positive returns on some of these other cyclical areas, and you're losing those positive returns and almost turning negative on financials and on materials. Excuse me. Let's take a look at some of these charts. In particular, the US dollar. Remember, the dollar has been looking really bullish, but it's not the dollar, its currencies are bullish right now, and it's actually the euro, which makes up most of this dollar index, is more bullish. The euro had been so bearish, had been dropping down. You can see it's kind of sitting on that big long-term downward trending line that it is using for support right now, and it's also got this 62% retracement level that's sitting on top of it. But I expect that during any bout of weakness, we'll actually probably hold our ground pretty well, as I don't expect a whole lot of dollar strength relative to the euro. Actually, as we've seen, I actually expect more euro strength relative to the dollar during any kind of bout of volatility. There's your global bond or U.S. bonds breaking through some resistance from July. So breaking up to a new high and 4% up above the moving average, and the intermediate line's higher than it's been in a while. So we are definitely kind of breaking out here and starting a new trend. The Ichimoku cloud for your TLT, you can see we are almost above 65 and almost to 2. So we're almost to an intermediate trending mode, which the last time we saw that was over here. So that's a very bullish sign for bond prices, which, as we know, is considered a safety trade, right? Safety asset class. There is gold, and gold's kind of flat right now, but I got an oversold cluster yesterday, and it's bounced off of that and closed above yesterday's high today, closing near the high, and those short-term sentiment lines coming back up and coming off of that cluster there. So we'll keep an eye on the rest of this near-term run and see if it gets through the moving average and gets those lines up to bullish territory, especially above 90 percentile, the signal that we're going to move our way on the intermediate line up back into bullish territory and potentially trend higher again off this low point. All right, for our trade idea of the day, I wanted to take a look at one of the stocks in the new Fangman set, right? All the major large cap tech names that have been acting so well as a safety, and Nvidia being one of them. It's barely got light pink shading now. The intermediate line's actually still above its market sentiment. We're still above the moving average by nearly 5%. So not nearly as bearish, though, if you look at this week's candle on the Hakinyashi charts here. Oops, not this one, sorry. It is this one here. If you look at their chart here, you can see we've had some really good bullish candles. They've been gradually getting smaller. As you can see, the differential below its moving average, and the PPO peaking at 30%. So that's how far up above the, these two. That's how big this gap is. Really, really high. PPO gap is about as high as we got over here. But now you can see that the differential's gone to really low levels. We got a transition candle there on that. If you look at the green arrows, you can see that we don't have dark green or light green shading anymore. We are in bullish convergence mode on the stock. So you're still above this, you're still MACD's still above zero, but it's below its falling moving average. And then today, we're really flirting with breaking that 17-day moving average, and there's not a lot of volume down here at all below that if we were to go a little bit further. If you take a look at like the DMI here, you can see that we have broken the bullish move. We were on some strong bullish move. We are now back below 25, not quite above 20 yet, but we're breaking that move there. If you look at the trend strength indicators, we are still strongly bullish, but you notice now we're not, we're staying below the green line. We're not below the blue yet, but we're staying below the green line. So you can see some signs that it's really kind of slowing down and converging with very little support. We're in the middle of the Bollinger Bandwidth. So that doesn't necessarily mean that we're going to tank here or drop hard to the downside, but it also kind of shows that we're just not strongly bullish anymore either. We're back below 60. We're below zero now. So an opportunity we can do a bearish trade, but not necessarily a strong directional trade, and that's where these short call vertical spreads come in. So if I were to sell the mid-30s delta, so this would be the 335 buying the 337 and a half, you can see your typical short call spread set up here. We make money if we stay down. We're already down below the short strike price. We just need that purple line to move up. Time decay. You can see where that break even is. It's actually above these recent highs. So if we continue at best to converge and not really go very much higher, then we can still make money from time decay. But if this is indeed the beginning of a bearish divergence, then there's not a whole lot of volume support, and we'll make money very quickly on that, because calls lose their value, don't hold their value nearly as well as puts do. So we'll make money really quickly, and if we can get 50% of maximum gain before the expiration date, then we'll take it and look for some other use that capital for another spread somewhere else and try to make an extra return on this particular upcoming January or December, this would be for January expiration cycle. We've got 29 days before we even get to the 20-day mark, so there's a good opportunity we can get 50% or more maximum gain, take it, and then do another trade before we get to 20 days, right? Because we got basically 4 weeks to do it in. All right, well, that does it for me today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel as well as our website at marketscholars.com. Click that thumbs up icon. Like us on Twitter and Facebook as well. Comment on the video. Have a great rest of your weekend, everybody, and we'll see you all on Monday.